Okay, so we'll start in next 2 minutes.
Yes, sir. Yes, sir. We can start, sir.
Yeah, okay. So today we will start with the standard costing. Okay. So what is basically the standard costing? Whenever we prepare a budget, okay. So we decide, how much quantity we required, then what would be the price of that quantity. Okay. So see, like if I want to sell, say for 1000 unit, this is my sales. Okay. Now what happened? I have an opening stock of say for 200 quantity, and I want to keep closing stock of 300 quantity. So how much I need to produce? Can anyone tell? Anyone can guess? If you recollect, like
1100.
uh, yeah, correct. 1100 we need to produce. Okay, so it is basically open opening stock plus product plus sales. Sorry, production. It should be equal to sales plus closing stock. So we have this number. This is basically the 200. This we need to calculate. This is basically 1000 plus 300. Okay. So 1300 minus 200 is basically my production is 1100. Okay. Then when I'm preparing a budget, so what I'll do, how much quantity of raw material I require to produce 1100 quantity. Okay, so say for one quantity of output, I may need the two quantity of input with a the standard price of 20. Okay, so my purchase budget or the material consumption budget is basically 2 multiplied by 20. It is basically the input quantity. This is basically the price per unit, and that I need for 1100 production. So my material consumption, standard material consumption is 1100 multiplied by 20 multiplied by 40. So 44, and then I think roughly, okay, 44,000. This is my material consumption. Okay. Any doubt here? How I calculated the material? These are all the standard number. These are all the standard number. Okay. So standard cost is basically means the formula which you are able to see on screen. Standard direct cost is standard price multiplied by standard quantity. So standard price is this one, and the standard quantity required is this one. Okay, so that I put in my budget. Okay, but if I see my actual consumption could be 40,000. Okay, it is that means what happened? I projected 44,000, but it is 40,000. This could be because of any reason. Actually, the price or like input requirement. Okay, instead of 2, it may be 1.9. 2 input quantity, it may be 1.9, and instead of price, it may be 19. Okay, because of that reason, there is a saving. Clear? Saving of 4,000 because of either we use the less input or we use the or we purchase at a less price. Here -1, here say for 0.1. It is saving. Are you able to get it? Okay. Why we are calculating this? Because we should know, means my budget is 44,000, but I am able to, my material consumption is, actual material consumption is 40,000. So the 4,000 saving which I got, that may be because of either I use the less quantity or either I purchase at a lesser prices. I hope this you are able to understand. Okay, and why? And we need to know, means it is because of price effect. Saving is because of price effect, or usage effect. Okay, that you need to know. Okay, so this is basically the standard costing. Means it is not basically means we calculate the standard price, okay, or the consumption at standard price, and we know the actual consumption, and now we need to just take a overall saving. Okay, it is not like this. We need to know it is because of price or because of quantity. Okay, so the formula to calculate this is, if I want to calculate the price effect, okay, if I want to calculate the price effect means I need to compare actual price and standard price, okay, and the common factor is basically in that situation actual quantity. So my formula is basically actual quantity multiplied by standard price minus actual price. Okay, so that is my formula for the calculating the price effect. For usage effect, I need to calculate differentiate in a quantity. So common factor is standard price. Okay, and then again the standard quantity minus actual quantity. Okay, so if the standard price is higher than actual price, okay, so whether I will get the favorable result or unfavorable result. Anyone can guess? My standard price is 20 and my actual price is 19. So I will get the favorable, the situation is favorable for me or unfavorable for me.
Favorable.
Yes. Because even I projected the number, higher number, okay, but actual number is less. So my cost is, overall cost is less. So this will give me a profit. Okay. So this is basically the favorable situation. Okay, now if I supposed to use the standard quantity of 2 unit, but I am using actually 1.9 unit. So this is favorable or unfavorable.
Favorable.
Again, yeah, correct. So this is also the favorable. Okay, in most of the books, formula should be like actual price may be the first and the standard price may be the less. Okay, but I mean this I calculated so that if I start to get the positive number, then it is favorable, and if I am getting a negative number, then it is unfavorable, like this. Okay, so that's why position like this. Okay, but you can use any formula, that is not an issue. You just need to confirm whether it is a favorable situation or unfavorable situation. Okay, so for direct material usage or the material material impact, there are two things we need to calculate: the price effect and usage effect. For the price, we need to consider a common factor, actual quantity. I mean, that also you need to see actual and the standard. Okay, so at both the places we are not keeping the actual quantity or actual price. Okay, so when we are calculating the price effect, of course we need to calculate the difference in a prices, but we need to compare it with the actual quantity. And whenever we are calculating the impact due to the quantity, we need to evaluate the difference in the quantity usage, but we need but the common factor is the standard price. That you need to keep in mind. Any doubt here? Okay, so this way we need to do all the calculation. Okay, so I'll just go through, or I'll first explain the yeah, okay, first we need to go like this. So purpose of standard costing system, we need to control the cost, data for performance evaluation, and the ability to learn from standard and improve the various processes. So it is basically, I mean, the basic reason is we need to know why we are in a positive situation or why we are in negative situation, and what we need to do. Okay, so either we can do the cost control, we can consider this as a performance evaluation, or and whatever the learning we took from the past performance, that we can apply for the future processes or to improve our processes. Okay, The base, and as we already discussed, the objective behind is just to aware, just to get an insight, whether we are getting a favorable or unfavorable situation, what is the reason behind it. Okay, so we need to evaluate the reason result, and we need to see how we can control it. Okay, so like as I said, a price something, if there is a unfavorable variances, okay, in price. Okay, so what could be the reason and what corrective action we can take? Anyone has any idea? So like instead of 2 rupees or $2, I need to buy at $2.2. So what I need to do, or what can I do in this situation to control my cost? Either you can look for alternate supplier, maybe even in geographically, if today you are buying from the US, okay, and you may get this the same material in a from the Europe or from Germany, so you can shift the supplier. Okay, or you may find an alternate material. Okay, say for any manufacturing process, you may require some carbon product, but instead of that you may use some steel plate or something like that. That could be the alternate. Okay, so that whenever you are going to evaluate, means when you see this is an unfavorable situation because of the price, okay, then how you can reduce the raw material price. Okay, so you have it, two option: either you need to look for an alternate supplier, or you need to look for an alternate material. Okay, so if you can control, if you have an opportunity to shift, then it is a kind of controllable variances. And if like there is a monopoly or you cannot shift, then it is considered as an uncontrollable variances. Okay, so that we just direct material we just discuss. Okay, and the same way direct labor. So again, like for in this, if I carried the same calculation, okay, so for I need to produce 11,000 quantity, okay, or 1100 whatsoever maybe quantity. Okay, per quantity need 2 hour. Okay, and the hourly rate is 20. Okay, so it is basically, again, the cost is 44,000, or 4,40,000. So it is basically 1100, 44,000 total standard costs. Okay, but actual is basically the 40,000, or I'll consider this time say for 50,000. Okay, the reason is we took to complete 1100 quantity, we may took like say for the 2,500 hour. Okay, actual, or I can say 2.2. Okay, and the rate is 22. This could be the reason. Okay, so here you will get, once again, if I apply the first is rate, if I consider the rate, I need to consider actual R, okay, multiplied by standard rate minus actual rate. So it is basically actual R, I'll consider 2.2, standard rate is 20, and it is 22. So you will get the positive or negative variances here. Negative, because the actual rate is higher than the standard rate. Okay, so you will get the negative variances. Okay, and then rate, and then utilization. So when we are calculating, so here the standard rate multiplied by standard R minus actual R. Okay, so again standard rate is 20, standard R is 2, actual R is 2.2. So here also you will get the negative variances. Okay, because you paid the higher rate, okay, and plus utilization, labor utilization is also at a higher level. So this is basically the negative variances. Okay, clear here? Means direct material and direct labor. Just you need to keep in mind, if you are calculating the price variances or the rate variances, price in case of the direct material and rate in case of the labor. Okay, so in that situation, you need the difference in prices or a rate. Okay, so actual quantity purchase, actual price minus standard price, usage standard price multiplied by actual quantity and the standard quantity, and labor hour rate, actual hours, actual rate minus standard rate, and the standard rate efficiency, standard rate multiplied by actual hours minus standard hours. Okay, so that is basically the I mean, particularly these are the variable cost variances. Okay, so price and the labor rate, okay, direct labor rate, that you need to calculate like this. Okay, so again I'll just revise. If you calculate the price variances, then you need to use the common factor as an actual quantity. Variances, then you need to use the common factor as an actual quantity. Okay, and the difference you need to calculate in a price. And if you're calculating the quantity or efficiency variances, then you need to consider standard price and you need to calculate the difference in actual and standard quantity or the R used. So we need to solve this example. Okay, so actual quantity purchase 200 unit, actual quantity, okay, and the standard price, material price variances. Okay, so we need to calculate the price variances, and just I'll just get the number here. Okay, price variances. If I calculate the price variances, then the common factor is actual quantity or standard quantity. Any guess? It is given here. If I'm calculating the price variances, then what could be the common factor? Actual quantity, and if I calculate the usage variances, then the standard price. Okay, difference I am calculating standard price minus actual price. Okay, here actual quantity, standard quantity usage minus actual quantity. Okay, now I'm putting the numbers. Okay, what is my actual quantity purchase? 200 units. Then the actual price and standard price, so 10 minus 8. Okay, here standard price 10, standard quantity standard quantity 100. Okay, so one more issue. Okay, so here one point also, when you are calculating the price variances, okay, so because see, like here they gave the actual quantity purchase and actual quantity use. So when you are calculating the price variances, you need to consider the purchase quantity. But when you are calculating the usage variances, then you need to consider the quantity used. Okay, so here 100 minus 110. Okay, so total is basically 200 multiplied by 2. So this is favorable or unfavorable? 10 minus 8, positive number. So it is favorable 400. Okay, and then here it is a negative number, means minus 10. So it is 100 negative, unfavorable. Unfavorable. Okay, so this way we are calculating. So here one catch point is basically the actual quantity purchase is 200 unit and actual quantity used is 100 unit. So when you are calculating the price variances, you need to consider the purchase quantity, and when you are calculating the usage variances, you need to consider the usage quantity. Any doubt here?
Okay.
Then laborer variances. So same way, rate. If I'm calculating the rate variances, I need to use the actual R. Okay, and common factor and rate, and then efficiency. So if I'm using then the common factor is standard rate. So actual R. So standard rate minus actual rate, and here standard R minus actual R. Okay, so we are taking the number again. Actual R work 450 and the standard R is 500. Okay, so 450 and the rate is basically 15 and 20. So 15 minus 20. Okay, and then standard R is 450 minus 500. Sorry, 500 minus 450. 450 and the standard rate is 20. Okay, so in this situation, like there is a unfavorable variances because it is a negative number. Okay, so it is 900. 5 multiplied by 450. So somewhere 2250. And here 50. So it is positive because 1000. Sorry, 750. Standard rate is, okay, this is actual. So standard rate is 15. Okay, formula is correct. The number which I put, this is wrong. So it is 750. Are you able to get it? So you just need to keep in mind the formula basically. So when you are calculating the rate or the price variances, you need to start as a common factor with an actual R or actual quantity, and then standard rate minus actual rate. And when you are calculating the efficiency variances, then you need to start with a standard rate or the standard price and efficiency or usage variances, and then difference in standard price, standard rate minus actual, standard R minus or standard quantity minus actual R, actual quantity. Then manufacturing overhead variances. Okay. So overhead variances is basically means it is not like because this is not the direct cost. Okay, so this we generally calculate on the basis of applied. I mean the standard rate applied. Okay, what is standard rate applied? Means when we calculate, I mean when we are doing the way we consider say for my budgeted overhead is 1 lakh, and if I decided to spread over the unit or the production or the quantity produced on the basis of direct labor used. Okay, so say for for 11,000 1100 quantity, I may need direct labor of are per unit. So it is 2200. Okay, well, consider here. Okay, so this is my output quantity which I want to produce. Okay, this is my total labor use, expected total labor, total labor use. Okay, and I decided whatever may be my overhead, I'm going to apply on this labor hour. Okay, or per quantity whatsoever maybe. I'll consider here the labor hour. So it is basically 2,20,000. I need to spread on a 2,200. So per labor hour, my cost is how much? 100. Okay. So whenever I'm utilizing one labor or the two labor hour for a particular product, okay. So whatever may be the direct material plus direct labor for production overhead, I need to add 100 multiplied by 2, it is 200. So that I'm saying, considering the addition of the overhead in a cost. So this I consider as a applied. Okay. So my in direct material, it is giving a total direct cost. Direct labor, it is also giving a total direct cost. But like the production overhead, we need to enter in a cost sheet as a overhead applied. Okay. Are you able to get me? Say for like product X, whatever may be the standard price. Okay. So actual whatever the actual price or with a moving average method or any method. Okay. By utilizing any method, I need to purchase two quantity of raw material and the cost is 2.5. Okay. So it is basically 5 is my direct material cost. The same way actual direct labor cost is 3. Okay, or I'll write 500 and 300. Okay, my actual overhead could be anything because it is not directly traceable. Okay, what I'm going to do, I will add this 200 is my product cost. Okay, so my product cost is basically the 1000. That this is basically the concept, means how we are using the overhead or how we add the cost of overhead cost to the product. Okay. See, direct material means I am aware at what price I am getting a direct material and how much quantity I utilize. Okay, so that's why it is easily traceable to the final product. The same way, direct labor is also easily traceable to the final product. But the overhead, which is not directly linked with the production processes, like facility means the factory building, insurance, supervisor cost. These are all indirect costs. Okay, you cannot determine the share of those costs which you can directly allocate to the particular product, particular project. Okay, so that's why what happened, what we do, we accumulate all this cost. Okay, and then we charge with a single rate. And how we are going to calculate the single rate? Like here we see 2,20,000 could be my total cost. Okay, and I decided to spread over direct labor utilization. Okay, so whenever for a particular product I am utilizing 2 labor hour, I need to add whatever may be the overhead per for 2 hours. So which is 200, means 100 is basically the per hour. Okay, overhead. Okay, and because per labor hour, because I utilize the particular labor, particular product 2 labor hour, so that's why I need to add 200. Okay, the same way if I decided instead of allocate over the labor on the output produce. Okay, means if I produce the 1 unit, then I can apply whatever may be my production overhead with respect to that unit. Okay, so my expected cost is 220,000, expected production is 1100. Okay, so in that situation, this could be 200, means per quantity. If I produce per quantity, I need to add additional 200 for my production. Okay, So again, the same way, whatever may be the direct material actual, whatever may be the direct labor actual, and then the 200 I need to add in my costing, okay, for a allocation of production overhead. Okay, so this is how we apply the production overhead to the costing. Okay, so that is the case. Now, what is the under applied and over applied? Okay, so on the basis of standard data, okay, I apply the 200 per quantity per unit production. Okay, I'm not using the R rate per unit of production, and I produce 1100 quantity. Okay, so total production overhead I can apply 2,20,000. Clear? Okay, means that I apportion or allocated to the cost of unit produce. Okay, so it is 2,20,000. But if my actual overhead is 2,50,000, okay, what does it mean? I charge less amount to the production. Okay, so then this is basically the under applied. Okay, and if it is like again 2,20,000 and my actual cost is 200,000. Okay, so it is basically the over applied. Clear? This is, I mean, this is slightly a tough concept, but I'm trying to explain in a proper way. Okay, so what happened? We calculate, we apportion or assign a production overhead cost on the basis of standard rate, but actual cost could be less or the high than the standard rate. So there is a question of over application or the under application. Okay, so here what happened? I produced the standard quantity 1100. Okay, and I charge with a standard rate production overhead to the produced quantity. Okay, but my actual expenses is less or the high. If it is less, then it is an over application because like I charge more cost to the production. Okay, and if it is high, then it is an under application. Okay, so that is the case. Okay, now what happened? Then remaining, like here the 30,000 under applied and this is 20,000 over applied. So this is again charged to PNL as an period cost. Okay. So see, whatever may be the 2,20,000 we charge to the produce quantity, if it is sell entirely, okay, so don't, then there is no issue. Okay, so what happened if it is sell entirely, then whatever may be the, like it is basically I charge here 2,20,000 on product. Okay, and the 30,000 as a period cost. So in PNL I charge 2,50,000. The same way I charge here 2,20,000 on a product, because when I sell the quantity, at that time the cost of goods sold charged to PNL, otherwise it is debit to the inventory. Okay, minus 20,000. This is my period income. This is my period income, and again it is in PNL, it is 200,000. Okay, so this can be happened only when whatever the quantity produced, I am able to sell the exact quantity. Clear? Okay, but if it is not sell entirely, out of 1100, okay, I am able to sell 1000 quantity. So in that situation, what happened? Like cost of goods sold, it is basically 200,000 because we charge per quantity 200 and we are able to sell only 1000 quantity. Okay, so here the 200,000 we are going to charge. Okay, on the basis of the sale as a cost of goods sold, and the remaining 20,000 is basically we need to park in a inventory account, which is an asset. So it is not the part of the profit and loss account. Okay, and plus 30,000. So it is basically 2,30,000. Okay, and the same way here, instead 2 lakh minus 20,000. Okay, so here it is 1,80,000. Okay, see what happened, like 2,50,000 is my total actual overhead cost, and if I consider the 1100 as my quantity, so this cost is basically, per unit cost is basically something, how much, just a minute, 227. Okay, so actual requirement is basically 2,27,000, because I'm able to sell the 1,000 quantity. Okay, actually, so it should debit 2,20,000. Okay, but debit goes is 2,30,000. So that is basically the variation. Okay, and the same way, 2 lakh multiplied by, so here also it is 181, 1100, so 181, 182 approximately. So it should be 1,82,000. Okay, but because here the over absorption of amount, okay, so that's why the additional amount goes to the inventory. Okay, so because of that reason this variation arises. Are you able to understand? Okay, I'll just re-explain. Over applied, under applied, when the situation arises, first we are absorbing the overhead cost on the basis of standard rate decided. Okay, if the actual expenses is more or less than the standard cost, okay, so then there is a question arises over application and the under application. Okay, so whatever may be the over applied and under applied amount, that we entirely charge to the PNL, debit or credit, irrespective of quantity sold or the quantity produced. Okay, so here what happened, like we decided to produce 1100 quantity, and we decided to charge 200 quantity per unit. Okay, 1100 quantity, 200 quantity per unit. Okay, if I sell entire 1100 quantity, okay, so then I can charge to the cost of production 220,000 on the basis of 1100 multiplied by 200. Okay, but my actual cost is 250,000. So remaining 30,000 charged to PNL as a period cost, means the full cost I need to charge to the PNL. Okay, so in that situation there is no issue. But if I am selling only 1,000 quantity, okay, so I can charge to the PNL 2,20,000, and the period cost is sorry, 200,000, and the period cost is 30,000, which is 2,30,000. Okay, but if I calculate 250,000 divided by 1100, okay, so my means with respect to the actual overhead, so I need to charge per unit 227, okay, to the PNL. I sold 100,000, so it should charge 227,000, but instead of that I am charging 230,000. So that is basically the effect of under applied and over applied. Clear? Not clear? Okay, I'll try to explain in a simple way. Okay, See, we decided that $10 we need to absorb on a cost of material or the production unit per unit, okay, as an overhead, okay. So it is basically if I produce the 100 quantity, so I need to like absorb 1000 quantity. Sorry, 1000 US dollar, okay. This is clear. This is basically the recovery rate, or we are charging, and this is the quantity produced. Okay. See, again, keep in mind why we are absorb or charge the production overhead, because we don't know how much cost we need to apportion to the particular product. Okay. So that's why we need to charge. I mean, we create a pool of all indirect production overhead cost, and we consider one basis. Sometime it is direct labor, or sometime this is the quantity produced. So here I am considering the quantity produced. Okay, I assume that I am going to expense out 1000 unit, $1000. Okay, which I need to apportion over 100 quantity produced. So my overhead recovery rate is 10. Okay, so if I produce one quantity, I will add $10 as a overhead cost. Okay, so this is basically the standard data. Actually, what happened? We produce 1100 quantity. Okay, but my expenses is total actual expenses is 1100. Actual expenses. Okay, we don't know at the time of you quantity you produce what can be my actual expenses. So whatever maybe I decided, I am going to charge $10 per unit. So in my production cost of 100 unit, I'm considering the $10 per unit. So that's why I'm able to charge $1000. Okay, $1000 as a production overhead to my cost of goods sold, cost of goods manufactured. Clear? Okay, so that is the past of cost of goods manufactured. Okay, but actual expenses is 1100. Okay, so what does it mean? This 100 is basically under applied. We are not applied, we have not applied to the production. Okay, so and this we need to treat as a period cost, means whatever may be the amount we need to charge off to the cost of goods sold. Okay, so so if I sell entire 1000 quantity, then there is no issue. It is basically all goes to P&L. Okay, but if I'm able to sell only 90 quantity, so in my production it goes 900, because 90 multiplied by 10, okay, and this plus 100. So it is 1000 goes to the P&L, okay, and the remaining 10 quantity like 100 is basically my inventory. Okay, actually what can be the situation? 1100 divide by 100, okay, so it is 1.1, okay, and multiplied by 90. Okay, so 990 should be goes to the P&L, because I sell the 90 quantity, but actually it is going to the 1000 quantity. So that is basically the variation. Are you clear on this? Anyone has any doubt? First thing, why we need to recover or charge the overhead on the basis of fixed rate decided. Fixed rate decided. Okay, and why there is a question of under absorption and the over absorption? Because we charge to the product, okay, with a fixed rate decided, but the actual expenses should be more and more, or the less. That's why this question of under application and over application arises. Whatever may be the under applied and over applied cost, that we need to treat as a period. We are not apportion over the quantity produced, quantity sell, quantity I mean whatever the quantity we transfer to inventory. This is purely charged to the P&L as a fix as a period cost. Okay, so because of that reason, sometimes there is an issue with the gross profit. So this is under application and the over application. The same thing. If the actual amount of overhead incurred in the period exceed the amount applied, the overhead will be considered under applied and the overhead account will have a net debit balance. So this will result in unfavorable variances because its actual amount of overhead incurred is higher than exceeded. If the actual amount of overhead incurred is less than the amount applied, overhead will be considered over applied and the overhead account will have a net credit balance. The variances will be favorable because the actual overhead incurred is less than the expected. So it is basically, this is over applied and this is under applied. Then variable and fixed overhead variances. So overall manufacturing overhead variances can be broken into variable and fixed. Okay, so variable and the fixed overhead variances. Okay, so variable overhead variances can be further, it is a rate and the efficiency in the same way. Rate and efficiency, the way we calculate the labor. Okay, and the fixed overhead is basically the spending and the volume. Spending and volume. Okay, so this is slightly easy because the same way, the way we calculate the direct material and labor, so you can calculate easily. This is basically the slightly tough. Okay, so I'll explain one by one. So variable overhead again means the actual hours multiplied by actual rate minus standard rate, and the efficiency is standard rate multiplied by actual minus standard hours. So the same way we calculate the labor hour. Fixed overhead, budget spending. So here actual fixed overhead minus fixed overhead. Okay, spending what is that? Actual fixed overhead budgeted. Okay, so I'll generally write in a reverse way. So budgeted minus actual. Okay, so this is my, I need to consider this as a total. Okay, so whatever may be the exact budgeted overhead, it is decided say for 1000, that I need to consider, and the exact like overhead I incurred, which may be the 1100. Okay, so this variation we need to calculate. So it is basically like in a purchase variances, if the actual say for the variable, any variable overhead or the purchase or the direct labor. Okay, so on the basis of standard price and the standard quantity, so amount is 4000 and the actual price and actual quantity, the amount is 44,000. So we never calculate the difference between this in any variable overhead. We generally calculate this, and then we add. Okay, and the finally we will get this number. But in a spending fixed overhead variances, we need to calculate exactly whatever may be the budgeted spending and whatever may be the actual spending. Okay, so like this minus this we need to calculate. Okay, whenever we are taking a practical problem, I will explain. Okay, but in budgeted fixed overhead, you need to calculate the difference between, whenever you are calculating the spending variances, you need to calculate the difference between total, whatever may be the absolute number for the budget and whatever may be the actual number. Okay, the difference between this, that is basically the budgeted variances. And fixed volume variances, so budgeted fixed overhead minus base cost allocated to the production. Okay, volume. So it is again the same amount, budgeted fixed overhead total minus means the overhead recovered means the standard recovered. Okay. Okay. On quantity produce. So there is no any actual data we are considering. Only the actual quantity we are considering here. Okay, means the standard rate, like 200 is my standard recovery rate. Okay, but I am able to produce only 1000 quantity. Okay, so that would be the amount. Okay, 2000, like 2200 is my budgeted overhead for 1100 quantity produced. Okay, but I'm able to produce 1000 quantity, so 2000 is my um, actual. I mean the overhead calculated with the standard rate. Okay, for actual quantity, and the 200 is my negative variances. Okay, that is volume. Okay, and like 2200 is my budgeted, whatever may be the actual, say for 2400. Okay, this is my actual variances. This way we need to calculate. So here minus 200. Okay, so this is something different. Okay, and the direct material, direct labor, and the variable production overhead, they are mostly in a same way. Okay, whenever we take an example at that time, I will clear in a more proper way. So application of overhead rate that I already explained. Calculated budgeted overhead cost divided by estimated cost driver. So sometime it is a unit or sometime it is a direct labor material driver. Then overhead applied standard cost of driver for actual level of activity multiplied by overhead. So means if I decided I need to recover $100 on a per quantity produced, then whatever may be the actual quantity produced, okay, so that I need to consider. So here it is standard cost means the 100 and the standard cost driver for the actual level of activity. So say for 1000 quantity produced multiplied by 100. Okay, so they gave the variable overhead actual hour multiplied by actual rate minus standard rate, and variable overhead efficiency standard rate multiplied by actual hour minus standard hour allowed for the actual production volume. Okay, so that is basically the variable overhead. And the fixed overhead, actual fixed overhead minus budgeted fixed overhead. So these are basically the actual numbers, and the for volume again budgeted fixed overhead minus standard fixed overhead cost allocated to the actual production. Now we see this example. Linsing produce wide gate and applies overhead cost based on the direct labor hour. Okay, so it is not on quantity, it is on direct labor hour. The table below provide the budgeted. Using this, calculate the efficiency variable overhead and the budget and volume of fixed overhead. Okay. So here you can see the budgeted number of wide gates. It is 4000 and actual production is 3800. Okay. Standard labor cost hour per wide gate. One labor hour. Standard labor hours total based on the actual production is 3800 and actual labor hour is 3900. So these two things we need to consider. Okay, and the standard overhead rate is 1.5, actual rate is 1.6, and actual variable overhead cost is 6240. This is actual overhead cost. Okay, now we need to calculate one by one. Variable overhead rate spending. Okay, so what is the formula basically? Like spending variances, whatever may be the actual hours multiplied by standard rate minus actual rate. Okay, so actual R is basically 3,900. It is given, I think so. Yeah, actual labor hour is 3,900. Okay, so 3,900, and then we need to, whatever may be the standard rate, it is given 1.5 minus 1.6. It is given 1.5 is a standard overhead rate, and the 1.6 is actual overhead rate. Okay, so this will give the 0.1, so 390. Unfavorable. Unfavorable. Okay. This is basically the spending. So what we did here, we need to consider the actual R use. Okay, exactly whatever may be the actual R, we need to produce actual number of wide gates. Okay, so that we need to use. Okay, and then we need to apply the standard and the actual rate. I mean, difference in standard rate and the actual rate. So here basically quantity produced is not much important. This we need to consider for the fixed production overhead. But here whatever, because we are applying the overhead rate on the basis of actual hours, so we need to consider 3,900 multiplied by 1.5 minus 1.6. Okay, so which will give the 390 unfavorable. This is my spending. Then efficiency. So for efficiency, we need to consider the standard rate, which is 1.5, and then the budgeted and actual hours used. So budgeted hour also we need to consider for actual production. So actual number of wide gates is 3,800 based on the actual production. So you need to consider the 3,800, and the actual labor hours 3,900. I think, yeah. Yeah, 3,800 and 3,900 minus 3,900, which is again unfavorable. Okay, so here actual R is actual R, but the standard data we need to calculate for the actual production, that you need to keep in mind. Okay, clear? Then fixed production overhead. Okay, first is spending. As I said, total budgeted minus total actual. So what is my budgeted cost? Fixed overhead. It is basically the 10,000 for actual fixed overhead cost and budgeted fixed overhead cost. So there is no any difference. 12,000 and 10,560. Okay, so it is basically the clear cut 1440. Okay, because the fixed production overhead is not depend on any level of production. So that's why whatever may be my total budgeted fixed cost with whatever may be the volume, and whatever may be the actual fixed cost, whatever may be the volume, that we need to consider. So it is 12,000 and the 10,560. Okay, so that is my spending variances. In all other places we are considering standard common factor, but in fixed overhead we are not going to consider the common factor, particularly when we are calculating the spending variances. Whatever may be the budgeted cost for whatever may be the level of production, and whatever may be the actual cost for whatever may be the level of production, that we need to compare. So here it is 10,560 minus 12,000, so it is 1440 favorable. For volume, what we need to do, my budgeted cost. Okay, what is my budgeted cost for actual volume, that we need to consider. So budgeted fixed cost is 12,000. Okay, so on that basis it is recovery rate is 3 per hour. Okay, so it is also given, but otherwise you can calculate. Okay, multiplied by 1 labor hour, so it is basically the 3 per hour. Okay, for 4,000 quantity, but I am able to produce 3,800 quantity only. So my recovery is basically 3,800 multiplied by 3. minus 3800 multiplied by 3. So which is, this is unfavorable actually. 11,400. So 600 is my unfavorable. Okay, so this way we need to calculate. Okay, so what we did in a fixed overhead, whatever may be the fixed cost, fixed budgeted cost for whatever may be the volume, and whatever may be the actual cost for whatever may be the volume, that difference we calculated. And for the purpose of volume, we are calculating the standard cost only. Okay, not the actual one, but standard cost for budgeted volume and the standard cost for the actual volume, that that differences we are calculating. This is basically the fixed budgeted and fixed production volume. Any doubt here? Okay, so when we do the example, at that time we may get more clarity. Okay, but just keep in mind this is slightly complicated concept. In CA also most of the students are not able to, particularly the fixed production overhead variances of the fixed overhead. Okay, so you need to do a practice, and if you face any issue, you can connect me. Then sales variances. So sales variances is again easy. The only thing is that because again it is depend on the price and the rate. So it is a simple formula. Means whatever may be the actual quantity sold minus standard price minus actual price. So this will give the sales variances. And for the volume, we need to consider the standard price and the difference in actual quantity and the standard quantity, like this. So sell price variances, actual quantity sold multiplied by actual price minus standard price, and the price variances, quantity variances, standard price minus standard price multiplied by actual quantity minus standard quantity. So in sales, basically we need to start with the actual, okay, because this way we need to consider, okay. So we can consider this example. In Cascade Company's January budget, the company shows 3,000 budgeted units sold and the sell price is 16 per unit. The company actually sell a 4,000 unit at a price of 4. Okay. Standard, actual. Okay. Quantity, price. So standard quantity is 4,000. Sorry, 3,000 unit, and the sell price is 16. Actual quantity is 4,000 and the sell price is 14. Okay, so if I calculate first price variances, in price variances I need to consider the actual quantity multiplied by actual price minus standard price. Okay, so here 4,000 multiplied by 14 minus 16, so it gives the negative. Okay, and then the quantity variances. So here I need to consider the standard quantity, standard price, which is 16, and then multiplied by actual quantity minus standard quantity, which is 4,000 minus 3,000. Okay, so this will give the, it is unfavorable, and this is basically the favorable. You can see 4,000, 14 minus 16, yeah, which is giving an 8,000. Unfavorable, and the favorable because the price is less than the anticipated. Okay, and the same is for the volume. So same, 16 multiplied by 4,000 minus 3,000, so which is 16,000 favorable, like this. Okay, so that we need to consider, for because sell price is also, means the sales price volume variances is also considered as a variable factor, so it is not the fixed one. So that's why it is again direct material, direct labor, variable production overhead, and the sell price. It is more or less in a same fashion. Any doubt here? So it is now again we come with a more complex concept. So that's why if you have any doubt in a previous concept, please discuss. Okay. Now mix variances. Okay. So what happened? Like I'm selling A product, B product, and C product. I assume when I'm selling A product at 100 quantity, I'm selling 20 product of B and 10 product of C. Okay, and every product has some contribution margin. So that's why if I maintain this ratio, then and only then I'm able to generate a profit. But because see, if A product has a less margin, B product has a moderate margin, and the C product has a high margin. Okay, but instead of this, I mean, I calculated my sale and cost of goods sold on this basis. But instead of this, if I sell 200 quantity, 10 quantity, and the 5 quantity. Okay, so even though I'm getting a proper sell price or the volume, okay, but still because the ratio get disturbed, I mean, so wherever I'm getting a higher margin, the sell quantity is less, and wherever I'm getting a less margin, the sell quantity is high, and because of that reason, I may end up with the loss. Okay, loss or less profit. Okay, so again, I need to know what is the reason of getting a less profit, even though I am able to maintain the sell. Okay, so for that, we need to calculate the mix variances. Any doubt here? Okay, so then the formula is basically the actual sell mix ratio for a product, okay, and the budgeted sell mix ratio for product multiplied by total of number of product we sell and the budgeted contribution margin per unit of product. Okay, so we take an example so that you can understand. Yeah. So it is basically means if you see like we are selling budgeted is basically the 4,000, 6,000, and 10,000, and this is basically operating income we are able to sorry 4,000, 6,000, and the total is 10,000. Here we are able to earn the 10,000, and here we are able to earn the 10,000. Total is 20,000. Okay, so we need to focus on a contribution margin 5 per unit and 4.17 per unit. Okay, but the actual result is 1,000 and 9,000. So even though my sales quantity is same, okay, but my contribution margin get changed. Okay, earlier I am getting for a one quantity 5 unit and 5 units. So it is basically the total contribution margin is 5,000 and the 4.1. So it is 37. So it is 42,500 instead of 45,000 because of change in production mix. Okay, so how we can calculate? Budgeted sell mix. So it is 40-60 ratio actual. So it is actual sell mix is 10 to 90. So we need to consider this 40-60 and 10-90. Okay. So here if you see sell mix is 40-60, 10-90. So it is 30-30, 10,005. So total variation is 2,500. Okay. So I'll just we consider for a first product Nova. Okay. So earlier it is 40% and now it is 10%. Okay. So if you see 40%, Now it is 10%. Okay. Multiplied by total number of unit of all product. 10,000. Okay. Which gives the, and the contribution margin is 5. So it is giving me a 15,000 negative number. Okay. And here 60%, and now it is 90%. So again, total number of unit is 10,000. Okay. And multiplied by 4.17, which is giving me the price of 12,500. Okay. And then this is minus and this is plus, so it is 2,500. See, again, what because of whatever may be, because of the change in the quantity sold, we need to calculate the variation. So this 10,000 is basically including both product. First thing. Okay. What we are calculating, because of product A, what is the variation, and because of product B, what is the variation. Okay. So this way we need to calculate. Okay. So here instead of 40%, now I am selling 10%, which carries the higher margin. Okay. So that's why there is a reduction in the margin. But here the product B, which the ratio is 60%, now it is 90%. So I am selling a more percentage. So that's why it is a positive margin. Okay. And this way we need to calculate. Okay. So again, I mean, this is basically you need to calculate for each product. Okay, difference in the share multiplied by total quantity. Total quantity of all product means, if they here A and B, if there is a B and C, so you need to consider the total unit of all quantity. All quantity. Okay, and you need to calculate the variation for each product, and then you need to summarize or make a total, which would be your mix variances. Okay, any doubt here? So it is basically, see, change in the product sold, percentage in a product sold. Okay, and then we apply to the total unit and the contribution for that product, and then we calculate the variances. Okay, so that is basically the variances. Any doubt here?
No, sir.
Okay, so I already see this is not so easy topic, I can understand. Okay, but whenever I'm going to take a question answer, at least try to guess something. Okay, so that I mean, I'm also able to understand. I mean, the what input I supposed to give. Okay, and you can memorize the concept. Okay. So we will take a 15-minute break. Then I already sent the question answers. Okay. So we will solve it. Okay. So we gather again 9:35. एक रीडेबल पड़ता है क्या? दुसरं होती. रीडेबल होते हैं. दुसरं होतं त्यांना सांगतो तुम्ही तिथंच ओपन करा. सोडू. क्लासमधनं बाहेर गेलो का मी? बरं होते आता 5 मिनिटानंतर 9:00
Papa, aku mau ke baruan. Jarak makan plastik. Hah? Jarak makan plastik.
Okay. Can we start now? Hello?
Yes, sir.
Yeah, okay. So now we need to start the question answer. Okay. So are you able to see the screen? And anyhow, I already sent the um, Word file. Okay. So the first question, and even if it is wrong, no issue. You can try to guess.
Allocating the cost.
Yeah, cost allocation. Question number two.
C.
The quick ratio exclude inventory and prepared to provide more rigorous test of liquidity. Correct. See, in why we exclude the inventory and the prepaid, because see, if the amount is given in a data, so that you can collect immediately. Okay, but for inventory you need to resell first, you need to sell first, and then you can collect. And the same way in a prepaid, you cannot collect the money, you can avail the service. So that's why we need to exclude while calculating the quick ratio. Question number three.
A.
Yes. Question number four.
D.
Yeah, divide by average total asset. Average we need to take because whenever we are calculating ratio where one element is profit and loss, then we need to take a average for the balance sheet number. Yeah, question number five.
A. ABC.
The process of creating formal plan and translation goods into a quantitative format. That is basically the like budget. ABC is basically activity. Means when we are calculating the cost on the basis of several activities. Say for like maintenance expenses. Maintenance expenses depend on the number of breakdown. Okay, or like machine setup cost. So that is also depend on the number of means when we start the machine, how many times we start the machine. Okay, so it depends on that. Just a minute, my pain is yeah. So this is basically the activity based costing. Okay, so whenever we are translating goals into the quantitative number, this is budgeting. C. Question number 6. You need to calculate the quick ratio. We already know what we need to consider in a quick ratio,
We do not have to count inventory.
right? What is the formula for quick ratio? What?
Liquid assets on current liability, I think.
Yeah, divide by current liability. Correct.
0.75.
0.75. Yeah, correct. So it is basically cash plus account receivable, AR. Inventory we should not consider. Short term payable and the short term note payable. Divide by account payable plus short term note payable. Okay. So yeah, 15,000 divided by 20,000, 0.75. Next.
A, because it is not the part of CCC.
Yeah. Target cash conversion cycle. Cash discount period. Yes. Question number 8.
Gross margin ratio.
Correct. D. Right. Question number 9.
C.
Cash. Correct.
Bec-
Increase.
uh,
Yeah. So cash is right answer. Question number 10.
So the difference between current assets or quick assets will be the value of inventory or prepaid expenses.
Correct. But what would be the number? Exactly.
Uh, we have to multiply 322,000 with 3 to getting current assets, or multiply with 1 for the quick assets,
Hmm.
and the difference
Right. So
is
here it is like this 3 divided by 1 and the 2 divide, sorry, 1 divided by 1. Okay. So difference is 2 divided by 1. 1 we are aware it is 3,22,000. So what is my 2? 6,44,000.
C. C.
Yeah. Okay. So that is basically this way we need to calculate. Okay. So 6 like C is the right answer. Question number 11.
Yes, sir.
A. Correct. Question number 12.
D, sir.
Yeah. So in regression analysis, we generally calculate dependent value on the basis of independent variable, independent value. Question number 13.
D.
B or D?
I think D.
D. Yeah, D is the right answer. Whatever may be the quality cost, we need to bifurcate external, internal, preventive, and the appraisal. Question number 14.
B. Depreciation.
Depreciation. Yes. Question number 15.
I think internal.
Yeah, not I think, it is correct. Internal failure cost. Question number 16. Mhm.
So loss of 500.
Loss of 500. Yes. So it is basically variable selling cost and variable cost is how much? Difference 2.5. Okay. Multiplied by 1800. So it is somewhere around 4500. And the 5000 is fixed cost. So loss of 500. A is the right answer. Question number 17. Okay. So here, once you can see, there is an increase in expenses of preventive and appraisal cost, and sorry, decrease, yeah, increase, and the decrease in expenses in internal failure and the external failure. Number is not matter. So that you just need to keep in mind.
So can you please explain option A or C?
Yeah, so an increase in inspection cost was solely responsible for decrease in quality cost. Means, like because we spend more amount in an inspection, because of that reason, the quality cost get decreases. Means the total quality cost. So see what happened. Earlier it is 1800 and now it is 1350. So that's why it is expected. And that is because we incurred a good amount in an inspection. That's why the total quality cost is goes down. Okay. And the C is increase in conformance cost. Okay, increase in conformance cost means this prevention and appraisal cost. Okay, and because of that reason, non-conformance, see, conformance, non-conformance means before using the product. Okay, I am incurring some cost to make sure that I am using a quality product. That's why it is a conformance. Okay, non-conformance means even though I am using a quality product, still I need to bear some cost to correct it. That is internal failure or external failure. Means after manufacturing. Okay, so that is non-conformance. Okay. So in C, what it says, an increase in conformance cost result in higher quality product and therefore resulted in a decrease in non-conformance cost. In A, they gave only one aspect. Because of that reason, the total quality cost goes down. And in C, they gave an indication because we increase the preventive cost and appraisal cost, and because of that reason, the internal failure and external failure is less.
I think C, sir.
Yeah, C is the right answer. Question number 18.
So it is pay early into number of days plus pay late into number of days.
Correct, like this.
Sixteen, sir.
16.
Yeah, pay on 10. It is 16. So it is basically how we calculate 30 remaining 30 pay on 38 day, and the 70% I mean on 38 days. So 70% people are paying on a 10 days. Okay, and the 30% paying on a 30 days. Okay, so if I calculate like this, it is 7 and 3 3s are 9. So it is 16. Okay. Question number 19.
Sir, I think we don't have to consider equity of $30 million.
What means equity where the question arises as current asset, current liability, and equity we should not consider. I mean, yeah,
So, Blue's ratio is 2.6. So,
right.
option D.
Option D, correct. Question number 20. Price variances we need to calculate. When you need to calculate the price variances, we need to take common factor, actual quantity or
We have
standard
to take
quantity.
we have to take budgeted or purchased.
Yeah, that I'm asking you. First, you tell me, and then I'll tell you.
Actually, uh, production and purchase. And the difference is
Which one? Which one?
actual. Actual
Actual, correct.
15,000
Yes, 15,000 you
and
need to take. Correct.
multiply the variances of 1.50.
Yeah, 1.5, correct. Means like a budget it is 7 and the actual is 8.5. So it is negative. Means 8.5 minus 7. Okay, so 15,000 multiplied by 1.5. So
22,500.
which is almost to 22,500 negative. Unfavorable. A is the right answer. Question number 21. Fixed cost variances. Fixed cost variances means spending variances. If you recollect in spending, what I told, what yeah, correct. Okay, so in spending, what happened, particularly in a fixed cost, you do not require to calculate anything, whatever may be the actual and whatever may be the budget. That difference you need to consider.
So, sir, variable cost plus fixed cost of actual and
नहीं नहीं
variable cost of
नहीं वेरिएबल कॉस्ट का अलग से निकलेगा. वेरिएबल कॉस्ट वी नीड टू कैलकुलेट इन अ डिफरेंट वे. मीन्स उसमें वो सब आ गया, प्राइस, रेट, यूटिलाइजेशन, यूसेज, इफिशियंसी, ये. बट फिक्स कॉस्ट एंड दैट इज फॉर स्पेंडिंग, आई एम टेलिंग यू, नॉट फॉर वॉल्यूम. ओके, so it is exactly the
We need to
difference.
take actual fixed minus budgeted fixed.
Yes, exactly. But you need to ignore everything, whatever may be the level of production, whatever may be the recovery rate, everything you need to ignore for calculation of the spending variances.
4,000
Yeah, clearly unfavorable.
4,000 unfavorable.
Unfavorable. Question number 22. Okay, so here also in the same data. Okay, so as you know, the conformance cost is high and the non-conformance cost is less. Yeah, so we already solved this. The A is the right answer. Okay, can we go ahead?
Yes, sir.
Question number 24.
वही A, activity based costing.
Yeah, it is activity based costing. Question number 25.
C 1015.
Yeah. So how we calculated this? Project beginning inventory, desired ending inventory, and the prior year uh, beginning inventory. So
Sir, I
that is
think prior year
that
inventory
we
will
need to
be
ignore.
ignored.
Yeah, correct. So it is 1085 and 100. On that basis, we need to calculate. Okay. So 100, 1000 plus 100 minus 85, right? 1015, correct. Question number 26. Okay. So you need to calculate where we can get the lowest operating cycle.
Sir, B या D.
देखो like whenever means the payable outstanding which save the cost, so that should be the long. पहला point. बाकी इन्वेंटरी और अकाउंट रिसीवेबल का कॉम्बिनेशन वी नीड टू सी. So like first is A and D that we need to evaluate, and then we need to see ki, where we are getting both are short. So D is the right answer. Days inventory short, sales in account receivable short means we are able to collect the cash early. In inventory, we are able to produce early, and the days payable in an outstanding loan. Okay, this may compensate each other, but here we are able to generate the saving at the both in both situation, and plus we are getting this benefit. So D is the right answer. Question number 27.
B, sir.
B, sir. 1.
So, 1. Sorry, B ones.
Yeah, find the coefficient of equal to 1. Question number 28. Fixed overhead spending variances. Again, keep in mind, spending variances. पड़क से वन होना चाहिए.
2000 unfavorable.
Yes. 2000 unfavorable. Question number 29.
Sir, sales upon assets.
Segment sales upon asset. Yeah. तो उसका क्या आएगा?
2.5.
2.5 A. Question number 30.
I think B, sir, because a flexible budget provide
Whereas
cost
static
allowances
budget
and
provide cost for one level of. Yeah. So B is the right answer. Question number 31. Price variances. तो actual quantity लेना है.
Sir, this is favorable 16,800.
Correct. So it is 20 minus 18.5 multiplied by 11,200, right?
Yes, sir.
Question number 32.
So there is no inventory or prepaid expenses or advance taxes is given.
But
So
correct.
can we calculate the
Yeah,
net
you need to
cash and account
calculate. You need to calculate.
Promotion account.
to
करंट असेट में से
5G?
बाकी माइनस करो.
So 700 is our quick assets.
Yeah.
Okay.
No, 700 is our quick asset. Correct.
0.77. So
Yeah, 78.
just 0.78.
Correct. Question number 33.
B, sir.
Which one?
B, cash collection of.
No, because of cash collection, there is no impact because cash increase and account receivable decrease. So it will not impact working capital. Someone says A. Yeah, A is the right answer. Refinancing a short-term note payable with 2 years. So we are converting current liability to long-term liability. So current liability reduce the working capital, and because we are transferring or shifting from current liability to long-term liability, working capital get increase. So A is the right answer. Question number 34.
We have to take fixed cost of a whole year.
Hmm.
So
कैसे भी निकाल सकते हो इसको, यानी क्वांटिटी पहले निकालो एंड देन सेलिंग प्राइस से मल्टीप्लाई करो.
75,000. 1 lakh, sir.
नहीं 75,000 किसने बोला था? एक मिनट. Like it is 2,500 divided by 60% multiplied by 100. तो क्या आया? $2,500.
7,512.
0.6. No, 2,000 fixed cost. Okay, this is per month. So 2,500 multiplied by 12, 30,000 divided by 0.6.
Will I got 750 limit?
75,000, sir.
एक मिनट. Right. Okay, 40% clear. It is not. It should be the 40%. What amount of annual sale? Yeah, fixed cost. 75,000. C is the right answer. Question number 35.
Sir, caused by internal failure.
Internal failure. Two only. कस्टमर का अगर कोई मिस्टेक है तो वी आर नॉट रिस्पॉन्सिबल फॉर इट. क्वेश्चन नंबर 36.
$21,000.
21,000. So it is again ending inventory, beginning finished good as budgeted. So 2,500 plus 20,000 minus 1,500. 21,000. Question number 37.
As I told already, A, decrease, and increase.
Increase, correct. Question number 38. 1,30,000. So variable cost is 60,000. If 15,000, what would be the total cost? So fixed cost is 40,000, and this variable cost is 90,000. ऐसे निकला ना? 130,000.
Six.
Yeah. 60%, correct. So fixed cost हम लोगों ने कैसे निकाला? How we calculated? 100,000 minus 60,000 is my fixed cost, and 60% is my variable cost. So that's why when I increase the production by 50%, so variable cost also get increased. So 60 to 90, 90 plus 40, 130. Yeah. Question number 39.
D, sir.
नहीं नहीं
D.
एक मिनट एग्जाम्पल जस्ट रिकलेक्ट करो लाइक
T sum actual overhead is less than applied.
ओके सो जितना वॉट एवर ऑप्शंस यू गेव यू आर नॉट गिविंग अ करेक्ट ऑप्शन अगेन like if I applied to 20,000 overhead and the actual overhead is 250,000. Okay, so what does it mean? It is under applied. Okay, I generally say the recovered and this is actual. Okay, अब now you just link and give me the answer.
Sir, but the question is opposite, right? The
Yeah,
actual
I know.
overhead is less.
Yes, so D is the right answer. I know the question is exactly opposite. So D, I
Which is
mean,
the right one, sir? Then?
D is the right. See, as per this, I mean, whatever I write on my tab, as per this, if my actual overhead is more than the recovered or the applied overhead, then it is under applied. So for over applied, actual overhead should be less than the overhead applied. So D is the right answer. Clear? Any doubt here? In case of the B, it is under applied. Okay. Anyone has any doubt to understand? Like if you see the A, the number of unit produced was the budgeted amount, but a larger amount of overhead was actually incurred. Okay, so that means the actual overhead is more. Okay, so if the actual overhead is more, then it is under applied. So that's why I mean, in case of the A and in case of the B, and the same is in case of the C. So that's why D is the right answer. Just imagine this: if I recovered or applied to 20,000 and my actual is 250,000, then it is under applied. So इसका exact उल्टा. So recovered is 220 and the actual is 200. Means the actual overhead should be less than to consider this as a over applied. So D is the right answer. Question number 40.
Second one, B.
Projected sales and purchase percentage in terms of payment. Question number 41.
C, sir.
C, inventoriable cost 60,000 and the period cost is 30,000. So, abnormal spoilage we can consider as a period cost. Okay. And the normal spoilage, while calculating the overhead cost, we are not consider this. So, it is automatically bifurcate in work in progress and the cost of goods sold. Okay. Or I can say the inventory. So, inventoriable cost 60,000 and the period cost is 30,000. Question number 42. कौन सा मेथड दिया है? वेटेड एवरेज.
40,400.
40,400 कहाँ से ले लिया? एक मिनट. नो. So, what is the difference in weighted average and first in, first out? Weighted average, we consider opening stock as well. Okay, and the first in,
Here
first.
only we consider units and ending
हाँ,
work in progress.
right. So, it is the two stage only. So, okay, you can calculate and then I'll tell you.
Is it 9,000, sir?
9,000, yeah. So it is basically the 7,000 total unit produced. This is including opening. Okay. And then 80% of 2,500. So it is 2,000. Yeah. C is the right answer. Question number?
So can you repeat once again, please?
Yeah, okay. See what happened in weighted average, we are considering the opening stock as well. Okay. So we are considering the opening cost, means I'll explain in some other way, quantity and the cost. Okay. Say for in this example, the 2,000 quantity, out of this 50% is complete and there may be some associated cost. Okay. So it is 2,000 opening and the cost may be the 1 lakh. Okay, not 2,000. You need to consider 1,000. And the fresh introduction is basically unit started during the May. It is 8,000. Okay, so like how I can say, the fresh introduction is basically five. Just a minute. Unit started during the May 8,000. So 500 is basically the abnormal, somewhere the loss actually. Okay, so that's why the 8,000 new units started. Okay, so it is basically 1 plus 2, 2,000, which is 50% complete. Okay, so out of this, 7,000 is fully completed and the 2,500 is WAP or the closing stock. Okay, so as we need to consider the opening quantity as well in weighted average, in first in, first out, we need to consider here like 1,000 plus 5,000 and then the 80% of 2,500 means 2,000. That should be 8,000 is for first in, first out. Okay, but in weighted average we need to consider the full 2000. Okay, so 7000 is unit completed and transferred total including opening, and the 80% of 2500, which is 2000. So that's why it is 9000. And the cost also we need to take in weighted average opening cost as well. Okay, and in first in first out we just need to consider the cost incurred during the year for calculating the average. Are you able to understand?
Okay, sir.
Okay, so I'll see if I get similar question, then I will explain. Otherwise, once we complete the question, I will explain again. Question number 43. During the month of June, you need to calculate.
Sir, 40,400.
40,400. How we calculated? The sale, okay, the cost goods contained in the cost of sale were purchased in the month prior to the month of sale. Vendor payment in the month following the sale, and all other cash are paid in the month. Okay, so what we need to do, we are calculating for the month of June. So sales recovery is basically 80% of the 40,000, which is 32,000. Okay, and the 20% of the previous month, 42,000. So it is 8,400. So that is my sales recovery, which is 40,400. Okay, they ask for the cash collected. Okay, so that's why it is 40,400. Yes, C is the right answer. We need to consider the 80% of June amount and the 20% of the May amount. Next question. Estimated total cash collection during April from the account receivable. Okay, so here for 6 months, in the month of sale 20%, month after the sale 10%, second month, and the 4% collect in the third month, and then the 1% is uncollectible. Okay, so we need to calculate for the period of collection during April. Okay, so here $65, $20, $10, $4, that you need to just keep in mind, and then you need to consider $65, $20, $10, $4, and you need to consider this cells. So you need to apply the percentage.
Option C, sir.
Option C.
1,73,400.
Yes, correct. So these are the 4 month sale. So here 65%, then 20%, then 10%, and then 4%. I think 65, 20, 10, and 4. And this way we need to calculate. Yeah. Direct material price variances. Price variances, when you are calculating, you need to use actual. and the purchase, not consume.
$1,300 favorable.
Yes, 1,300. So you need to consider actual quantity, which is 6,500 multiplied by the rate is
3.8
4
minus
minus 3.8.
3.2.
Yeah, one of the same thing. No problem. 1,300, which is favorable. A is the right answer. Next question. Increase the working capital.
Refinancing.
3,000 to a long-term note. Yeah. So for increasing working capital, either you need to increase the current asset or reduce the current liability. So in case of the D, refinancing 3,000 of account payable to a long-term note payable means we are shifting current liability to long-term liability. So D is the right answer. Question number 47. Weighted average contribution margin.
C.
C. So like it is the contribution margin, each product is 75, then 40, and then 35, and we need to apply the percentage 30%, 50%, and the 20%. So here it is 7, 20, and the 30% of 75 multiplied by 0.3, it is 22.5. So 22.5 plus 20 plus 7, 49.5. Yeah, C is the right answer. Question number 48.
Is it C, sir? Again. C or D?
C or D, if a firm increases its cash balance by issuing additional share of common stock, working capital increases and the current ratio remain, but working capital increases, then current ratio should also increase, na? It is not the, see, issue of shares. I mean, the liability increases in a equity, not current liability. So C and D cannot be possible.
So, but if we see through the share perspective, the shares we keep for the long term also, right?
Yes, so that's why it will not affect the working capital. Means what happened? The cash balance increase, which is a part of working
So it will
capital.
be B.
Yes, no, no, not D. Cash balance
B. Second.
increase in current ratio, increase working increase, and current ratio also get increased, na? See, current ratio is basically current asset divided by current liability. Current liability as it is, current asset increase because of cash. So current ratio also get increased. Working capital also get increased, and the current ratio also get increased. The second effect, working capital plus and the equity plus. So equity is not the part of current liability. Okay. So what happened? Your current asset increased because you are getting the cash. So that's why current asset, working capital get increased, and parallelly your current ratio also get increased. Are you able to understand?
Yes, sir.
Question number 49. So here they gave current liability, they gave here, and here they gave the detail of the asset. So you need to select what are the asset you need to consider for calculating the working capital. Yep.
P sir, 6 lakh 60.
6 lakh 60.
Yes, sir.
Okay, 6 lakh 40,000, and then you need to consider 2, 3, 7, 13. 13 minus 640. Yeah, 6 lakh 60,000. Correct. Right? C is the right answer. Question number 50. Current ratio and quick ratio. Okay. So see, this is just a number. So you can just read this para and accordingly decide whether what is the impact of current ratio and quick ratio. You do not require to calculate anything. Mhm.
In case of current ratio, there will be no effect.
Current ratio,
No effect.
no effect. What about quick ratio?
Decreases, sir.
Decreases,
Decrease.
sir.
Yeah, decrease. A is the right answer because cash gone, but inventory we are not going to consider in a quick asset. Okay, so that's why numerator get decrease. Okay, so A is the right answer. Question number 51. And
A.
the cash budget
Is
is
it B, sir? B.
again B.
B.
B is the right answer. Okay. Always the sales is your first budget activity. Okay. So cash budget is almost last activity. So cash budget is typically done before all other budget is not true. Question number 52. Cost of goods sold you need to calculate. Okay, beginning inventory and closing inventory also they gave.
Sir, indirect cost will be ignored or not?
We need to take manufacturing. So it is a part of cost of goods sold.
Four lakhs, sir.
It is,
For like
yeah, 4 lakh. So how we calculated? Cost of goods sold 6 lakh, 8 lakh plus 5 lakh, right? 19. And then 6 is a beginning inventory minus 9. No, something. Okay, cost of goods sold.
Finished goods.
Finished goods. Cost of goods manufactured. Okay. 6 lakh is not required. Cost of goods manufactured 8 lakh and 8 and 5, 30.
1 lakh plus 8 lakh minus 5 lakh.
30. No, what you take 8 lakh cost of goods manufactured.
And the
Okay.
finished goods, beginning
Okay.
inventory, and ending
Yeah.
ending inventory, finished goods.
Yeah. Just a minute, 8 lakh and then, okay, 5 and 4, 8. Minus 5 plus 1. Okay, understood. C. Okay. Question number 53.
A, sir.
A. Percentage of defective product. Question number 54.
A or
A.
D?
Now, performance measurement we are doing in-house. So benchmarking is a A.
Okay, sir.
Next. Account receivable turnover ratio. So this information is sufficient.
Sir, we have to take average of accounts receivable.
Yes.
So net sales divided by accounts receivable, average of accounts receivable.
Yes. So it is 103,200 divided by what is average?
7.5, sir.
7.5.
D. Yeah. Next question. Profitability.
B, sir, net income divided by net sales.
Net income divided by net sale. Yeah. Correct. Next question.
Kaizen,
No. Kaizen is basically for continuous improvement. Multi-dimensional, see, multi-dimensions means you are considering all the aspect of the businesses. Okay, Kaizen is basically related to the shop floor only.
is it A, sir, balance
A,
scorecard?
balance scorecard. Yeah. Question number 58.
A or B?
No, why it is decreases acceptance? If it is a participative, then everybody is involved in a process, so everyone already accepting. And it is also not less accurate. It is more accurate because everyone giving a their own prescriptive or their own like thought processes. So now you need to select from C or D.
Time consuming.
Yes, time consuming. It also enhance the motivation because everyone is participate. Okay, so C is the right answer. Inventory turnover.
So COGS upon average
Average
inventory.
inventory, correct.
A 2.5.
2.5. Yes. Then, yeah.
So it is 2, no, sir?
Which of the following it is? No, no. Earlier
That
question.
inventory turnover.
Inventory turnover. No, it is. Yeah, it is 2 actually. Okay. Cost of 5 divided by 2.5. So it is 2. Yeah. Right. Cost of goods sold divided by average inventory, which is 2. 2.5. So that's why the ratio is 2.
Yes, sir.
D, sir, direct material and conversion cost.
Yeah, D is the right answer. Correct.
May you please explain, sir?
Okay. So see, product cost is basically direct material plus direct labor and plus production overhead. It includes both direct in variable and the fixed. Okay, so conversion cost is because I am getting a material and then I am applying some processes, which is my conversion cost. Okay, so this is my total production cost. Okay,
Okay, sir.
so this is conversion. Okay, and if I consider this one, then it is my prime cost, because without this I cannot do anything. So that's why it is my prime cost. Means the production overhead is avoidable, but the direct labor, direct material you cannot avoid actually. So that's why this is prime cost, and direct labor plus production overhead is conversion cost.
Okay, sir.
Next. Yeah, this is done. Now this one.
Employee training.
Employee training. Yeah. So this is basically the preventive cost. Okay. So not an appraisal cost. Yeah. Okay. So tomorrow we will take the simulations for this topic. Okay. So anyone has any doubt till now for any subject? Okay. I hope everyone got the Baker access.
Yes, sir.
Okay.
Yes, sir.
Okay. So are you able to use it, or you have not tried at all? Okay, so I'll just explain. Like, see, this is basically means the various topic covered here. I am also teaching in that sequence only. Okay, so if you see, if I click on the first topic, so here you will get the digital textbook and the outline and glossary, so that you can study. But more important is basically the MCQs which you need to. Just a minute. So you will get the MCQ here actually. Yeah, here. So then you can all question unanswered or incorrect. This way you need to use it. So begin in MCQs. So you can get the, and this basically the frame only as per, I mean, the way you are getting in an examination. Okay, so you need to solve this on your own. Okay, so I'm taking some MCQs in a class which is almost 20% of total MCQs, but the remaining you need to do the practice. Okay, the one good point is, I mean, if you do not required a spend huge setup time, I can say, because the each MCQ you may need 2 to 3 minutes. So if you have a half an hour, you can do your studies. Okay, so this is one issue. For simulation, it is slightly tough. Okay. So I suggest means along with the MCQs, you need to start simulation as well. Okay. So at least in a day, you are able to solve one or two simulation, which will give you a good time to the practice. Okay. So again, so simulation, like here you can select and then you can start. So one by one. Okay. So anyone started to do a practice on simulation or MCQs? No one has started. I mean, when you people are planning, because I might prepare this by 15th of December. So anyone started to plan means when they can appear for an examination.
So I'm planning for far.
Okay. So have you already started to study on a FAR?
Yes, sir.
Okay, okay. So, I mean, how to use the Becker, you are aware of it. And what is the status of your evaluation process?
I've applied for transcript. It is yet to come.
Okay,
So once transcript come, I'll apply for evaluation.
okay, okay. So, anyone has any issue facing in completing the evaluation process, or no one has started?
We didn't start it yet, sir.
Okay. So see, try to start as early as possible. Okay. If you're facing any issue, drop me the message. Okay. You may need to take a slight follow up with me. Okay. So along with me, I have one more colleague who is also imparting the CPA training. Okay. So she is also going to help you out. Okay. So, but you need to complete the simulation evaluation process as early as possible. Okay. This is the one time process actually.
So once I get my transcript, I'll contact you, sir,
Yeah,
for
yeah, yeah.
next process.
Yes, no problem. Okay. So keep in mind. Any other issue, any point we need to discuss? I mean, how I can guide you for preparing the exam or anything related to the evaluation beside this regular study?
Sir, maybe you can explain the whole process once in short, so
Okay.
that everyone may not have any doubt at present, but at least they come to know the process and then they may have some questions regarding that.
Okay. Just a minute. See what happened. You need to first do the evaluation process. Okay, evaluation process is basically whatever may be the India qualification. Okay, they are giving a points or credit. Okay, according to the US qualification. Okay, so it takes almost 3 month time. Okay, after that you need to apply. Once you get the evaluation, then the things are quite easy. Okay, you can conclude for which state you need to apply. Okay, after that you need to book for NTS, which is notice to schedule. Okay, once you book for the notice to schedule, you need to appear for an examination in 6 month time. Okay, once you got the NTS, then you need to book for a exam. Okay, and I mean, so you can book for an exam in India. There are 7-8 centers. Okay, and you need to go to the Prometric Center and you need to appear for an examination. Okay, so these are basically the step. Okay, So the biggest point is basically the evaluation process. Rest two are quite simple. It is not very much difficult, and it is not even time consuming. Means in 7 8 days you will get the notice to schedule, and 1 or 2 days you can schedule for an examination. Okay, but the evaluation process is a very much tedious task. Okay, so that you need to finish as early as possible. Once this is done, then you can decide what paper you need to means which paper you need to give, and accordingly for that paper only you need to get the NTS. Don't take the NTS for all the papers. Okay, if you take the NTS for all the papers, then you need to complete entire CPA in a 6 month time. Okay, so that's why paper by paper you need to get the NTS, and then accordingly you need to schedule for an examination. Okay, and related to the fee structure, so here like it is approximately 225 US dollar. Okay, and when you are complete the evaluation, then one time 200 US dollar you need to pay for the registration, and the per paper for NTS I think it is $390. Okay, and then for examination you need to pay roughly around $275, like this. This is the, and this basically this two fees you need to pay per paper, not for all four paper, but 200 and 225 you need to pay for one single fees for all four paper. Anyone has any doubt here?
No, sir.
Okay. Okay, so yeah, and like whenever you find any difficulty you can approach me, that's not an issue. Okay, but again I'm telling you because you need to regularize you in your academic, so it is better at least try to solve 3 to 5 questions on a daily basis. Okay, any other point we need to discuss?
Okay, so I think they are not yet in that position to appear just now. So maybe they do not have any doubts at present. So
Yeah.
when they start appearing or preparing for that time, maybe we will come back to you.
Yeah, definitely, no problem. But again, I'm telling you, see, 3 to 5 questions, solving the 3 to 5 question is not a big task. Means it is a 10 15 minute, but you can develop the interest in this course. Okay. Okay then. Bye everyone.